someone who is now letting go of that loss aversion mindset and moving into a place of abundance. And as an investor, you really get to be part of this incredible journey without needing to actually put your time and energy into building it. So now we're going to dive into the actual meat of becoming an angel investor. Why become an angel investor now? Why is now the best time to do so? We're going to go over the history of regulation crowdfunding and just why that's important and applicable to you. The return potential of private asset classes compared to public asset classes, and then the impact on the future and the diversity of startups, the diversity of founders and investors that you can have by participating in something like startup investing. A brief history on regulation crowdfunding, for those of you who don't know, is that in 2016, the SEC passed something called Regulation Crowdfunding, also known as Reg CF. And this enabled anyone, regardless of their income level, to invest in startups. And prior to Reg CF, you needed to be an accredited investor. Accredited investor is someone whose net worth is $1 million, or they've earned $200K in the last couple years in income, and they can invest up to a certain amount in startups. So VCs can invest. These accredited angel investors used to be able to invest. But the problem was this was primarily concentrated in New York City, in San Francisco, in LA, and it was an ivory tower of a small homogenous group of primarily white male investors. And this led to a skewed and biased funding environment. So much so that today, still 94% of investors are male. And that results in only 2.2% of funding going to female founders and a mere 0.2% going to women of color. So there's a lot that's happened since regulation crowdfunding has been passed. Since then, in 2019, from 2016 to 2019, people around the country have now invested more than $100 million and over 1,000 companies in startup deals. Reg CF has been a huge game changer, a monumental shift in power. And now $500 million has been invested into private startups via equity crowdfunding platforms like Republic, WeFunder, Start Engine. We'll get into those a bit later. And what this means for you is that as an individual investor, you can have a stake in companies with an investment often as small as $100. And what that also looks like in terms of impact is that more immigrants, more minorities, more female-founded, and more socially impactful businesses are receiving the attention for their excellence and impact as a business. So there's many reasons for you to invest. First and foremost, of course, it's the financial return that you can get from investing in startups at an early stage. But startup investing also allows you to be part of a greater journey with startups. And equity crowdfunding is really the vehicle through which you can invest. We call it Kickstarter, except with equity. Instead of getting prizes, you're getting ownership in a company. And we'll talk through some of these platforms a little later in the class. But this is the high-level overview of why now. Why is it that you haven't heard about this so much in the past? It's just very recent in terms of regulation. And angel investing in startups is an incredible high growth opportunity. And the reality is most people still have no idea this asset class is even available to them. As you go online, you often see an abundant information about how to invest in traditional investments, stock market, real estate, index funds, but there's very little reliable information about startup investing for the average investor. And that means you even being here, you taking action early to learn early about it while this asset class is overlooked means that there's a big opportunity for you if you really dive into it and carve a niche out for yourself. And I want you to think long term, because at the end of the day, the big difference between public and private assets. So public assets are the stock market, they're bonds, whereas private assets are startups, real estate, and so on, cryptocurrency. And the traditional recommendation has always been to create a balanced portfolio where we have 60% stocks, 40% bonds. But the reality is, especially in 2020, going to 2021, this is a really outdated recommendation. When you look at the average stock market return over 10 years, there has been a 9.2% return for the past 140 years, according to Goldman Sachs. And if you are not a professional investor and stock picker, it is very rare that you can actually beat these odds. In private markets, you have a substantially higher possibility for your return on investment than what you could ever make investing in publicly traded companies. And if you just take a look briefly down here, these are from the fund side of things. But you have the NASDAQ, you have the S&P 500. These are your public companies. And you go all the way to seed funds. So these are venture funds. These aren't individual angel investors, but even on a weighted average, when you look all the way across the board, at the end of the day, seed funds and venture funds do outperform over time from public markets. And when you're specifically an individual angel investor, that can go much higher, because typically venture funds don't get to invest in that many deals, whereas angel investors will talk about how to diversify and how many companies you should be putting in your portfolio to maximize and possibly hit that exponential return. The whole point of this, there's no part of this masterclass that is recommending that you put all your eggs into the startup basket. Diversification, I'm sure you've heard, is key to everything that you do in investing. So within the portfolio, your private portfolio, the biggest thing about diversification is finding highly uncorrelated asset classes to balance risk and reward. What does that exactly mean? The main thing is that you are trying to invest in private startups because they are mostly uncorrelated with the stock market. So if you're putting all of your eggs in the public equities bracket, then you are not really creating enough diversification. When you look at bonds, we don't really have enough reward, especially in this particular environment that we're in now. And then stocks, a lot of people are saying it's very volatile right now. Sometimes it's up, sometimes it's down. And you can track it. But unless you're going to be there in and out every single day trading, it's just not worth it to spend your time on stocks when you could actually put your money in index funds and robo-advisors. So my recommendation here is, if you aren't an expert, don't gamble on the stock market day in, day out, and use your time there. Now, when we go to startup returns and the exponential potential there, the potential to earn in startups is anywhere from 10x to 1,000x your initial investment when investing in a company at its earliest stages. So I like to just put some context around this. If you had invested 20K into Uber's earliest funding round, today it would have been worth well over $200 million. And if Uber had been invested and available via crowdfunding and you had invested $100, you would now have over $1 million. And that's really the exponential power of startup investing when you've chosen your niche and you know what it is that you're looking for. And then just a quick thing that I want to talk about when it comes to mindset shifts between public companies and private companies. If you are invested in the stock market, one of the things that we often do is we are figuring out what could go wrong. So public companies have big teams behind them. They often have great PR firms, great marketing firms that can really paint a strong narrative on why this company is doing well. And they have an incentive to do that because they want to appease shareholders. Your job as an investor, when you're looking at public companies, is to figure out what could go wrong. On the flip side, when you are looking at startups, you actually have to take a different approach, because startups have they're very early on. They have grassroots efforts. They don't yet have a fully fledged team. They don't even have a fully fledged product oftentimes. And so what your role is as an early stage angel investor is to ask what could go right. And that takes a big mindset shift. And that's why we talked about loss aversion, scarcity, fear early on, because you cannot be a good angel investor if you don't really learn how to cultivate that optimism and forward thinking in the way you look at companies and you look at the future. Last note here is about why I'm really excited about startup investing, why I started to allocate a portion of my investment portfolio into angel investing in the first place, is that startup investing is the only kind of investment where you get direct access to the founder's vision from the very beginning. And it's important to ask yourself as you are going into this, as someone who's looking for financial returns, but also asking yourself, what kind of future do I want to see? What kind of future do I want to support? And then from there, find the founders who are building companies that align with this vision and think about how you can make your money work for the betterment of the world. That is really, for me, I always look at double bottom line impact, and that is how I think about directing my money. So one final here is that startups have the greatest upside potential. And that's something you should really just take away as someone who is now letting go of that loss aversion mindset and moving into a place of abundance. And as an investor, you really get to be part of this incredible journey without needing to actually put your time and energy into building it. As an entrepreneur myself, it's a huge shift and something that is very pleasurable and exciting for me.